Why do we only start caring about big structural problems when they begin to affect rich people? I was reminded of this when I saw this Bloomberg article that basically talked about how wealthy people in New York are beginning to struggle with housing costs. And if you live in New York or even just follow what's been going on in New York, you might know that housing, especially, has become increasingly unaffordable for many, many, many people in this city, particularly middle and lower income people. And yet, I feel like it's become even more part of the lexicon in the past like 6 months or so, specifically because there are these very high profile people that make high six figures that are complaining about how much money they have to pay in rent. And I think the reason why we care about structural problems more when they affect wealthy people or begin to affect wealthy people is because that threatens the whole system of capitalism's fundamental promise, which is that if you play by the rules, and achieve success, you will be rewarded with security and comfort. So let me explain what I mean by that. When lower income people struggle with something like housing, which is a structural issue, it often will get reframed as a personal failure. Like they didn't, maybe get the right education, or they made the wrong choices, or they lack financial literacy. And this narrative very much centers on individual responsibility rather than larger dysfunction in the system and in our society. And there's this very implicit assumption, especially in America, that poverty is somewhat natural or inevitable. So struggles at the bottom don't always signal the same systemic breakdown as something that is affecting wealthier people. But when someone making 200K can't afford, living, this whole story of the meritocracy really collapses, right? Like society sees somebody making $200,000 as someone who's doing everything right. And if the system isn't working for them, then that exposes that the problem is not an individual problem, but a structural failure. And in the past, I've talked before about the comfort class, and this is the class of people that will, lead the narrative in the country around poverty and the economy, whether that be the media narrative or the policy narrative. And this isn't always ultra, ultra rich people, but it's typically very comfortable people who are writing about, talking about, and creating policies about a reality that they often have never lived and will never live. And so when they themselves are experiencing something like housing affordability, that's when that housing affordability enters the narrative because it's directly affecting them. And so basically, I think articles like this kind of have this like underlying story that kind of highlights the sort of sad reality of these types of issues where we sort of structured our concern around structural issues around proximity to power rather than severity of harm. A problem doesn't become real in our eyes until it climbs the income ladder high enough where the people that have the platform and the influence will start to demand solutions.
In this video, we're seeing a lot of Americans be in a huge financial crisis. Things have gotten so bad in America. People have given up on the American dream. Life has become very unaffordable unless you have multiple sources of income. It's just a very sad time because a lot of people just are giving up on the American dream of owning a house, having kids. Everything is just too expensive. People can't even live on their own because bills are just so high. A lot of people, including myself, have been feeling the financial stress of all of these bills continuously increase year over year. Medical premiums for 2026 have almost doubled for most people, which is just insane. So everyone just feels like they're getting further and further behind because wages have not kept up with this insane rate of inflation. And people are just having less and less money in their pockets than they used to. So it's just a very unfortunate time that we're living in. I want to hear from you guys in the comments below how you're doing, and take a look at the rest of these clips.
Cost of living increases are not raises. Like we just did at our company that I'm the CEO of, we just did cost of living increases, and we did them for everybody in the company. Social Security Administration said 2.8% was the cost of living increase. Great, everybody gets that cost of living because that's the pace of inflation, just to keep up. If you are a company who's out there and you're saying, hey, here's your raise of 3%, when really it's just cost of living, that's not the same thing. That's not the same thing. You need to give raises separately from cost of living increases, and raises come from doing a great job. Cost of living increases are just to keep up with inflation. That's it. It is your basic duty as a leader to make sure that people are taken care of. And moving people up to keep up with inflation is just a good thing to do. I don't believe that the government should tell us to do this. I just believe that you need to do it as a leader. Do the right thing. Take care of your people. And if you want to keep becoming a better CEO, a better leader, then follow this account. And I will tell you everything that I know, at least from the mistakes I've made and the things that I've learned over time on how to run a great business.
Oh, I almost came on this app and cried my eyes out yesterday because I know I can't be the only one that's tired of struggling financially. Like, to not see your whole check, or as soon as you get paid, it's gone because you got to pay bills, or I got to sit this one out this time every time. Barely being able to get the things that I need, can't even get the things that I want. Like, it's so ridiculous nowadays. Like, it is so hard. And I know I can't be the only one. Something gotta budge.
Really only one thing that separates the top 10% of earners in America from the lower 80% of earners in America. And right now, we are in a K economy. So you have to figure out if you're at the top of the K or the bottom of the K. And if you're at the bottom of the K, I'm going to tell you how you can transition to the top of the K in this particular economy. So the one thing that separates you is not your income, and that's what everybody thinks it is, but it's actually what your money is attached to. Hear me out. First of all, please remember, outside of me building 5 multi-million-dollar companies, outside of the fact that I've helped over 900 people create six-figure incomes, outside of the fact that I've helped 191 people make $1 million in less than a year, outside of the fact that I have 7 clients that earn over $10 million a year, yeah, 8-figure earners, I also have a degree in finance. I actually graduated cum laude, and I understand this type of stuff quite well, which is right now we're honestly in one of the worst economies that we can be in, and that is a K-shaped economy. And so that basically means that the top 10% of earners in America are responsible for about 50% of consumer spending. I don't understand because I feel poor every day. Baby, you are not crazy, okay? Your money is buying less because your money is tied to your wages. But the top 10% money is tied to an asset. So let's talk about how you can move from the 80% to the top 10% and how you're going to be able to do it expeditiously. Okay, I'm not talking about something that's going to take you 5 years, 10 years, 20 years to pull off. I'm talking about you literally can change this in a matter of 18 months if you buckle in and listen to your big cuz Ashley Ann. Have I steered you wrong yet? No. So let's go. You're in a K economy. That top 10% is able to continue purchasing things is because their money is tied to assets. So that means they have insurance policies, they have stocks, they have crypto, they have real estate. They have different forms of investments. They're not dependent solely on their wages. So the inflation that is crushing 80% of Americans right now is actually assisting this top 10% of Americans. So when you get your paycheck and now you can purchase less with your paycheck on the back end, because that cost of a good or service went up for that 10% because their money is tied, let's say, for example, to the S&P 500, that means that those companies made more money, right? The S&P 500 is up 20% this year alone. So if you have, let's say, for instance, some index funds, which allows you to purchase a little bit of all of those top performing companies in America, you're getting a higher return. Your money is making money. So instead of you losing money the way a consumer does, because a consumer's money is tied directly to their wages, that means as the price of, let's say, for example, a bottle of water goes up, well, that means you can buy less bottles of water with your dollar. As a matter of fact, there was a time in history you could actually buy a bottle of water for only a quarter. And then it went to 50 cents. And then I think we all remember it going to 99 cents. And now it's a little bit over $2 for that one bottle of water. So now instead of your dollar being able to buy 4 bottles of water, it can't even buy one bottle of water. Now you need $2 for one bottle of water. So even though you're still getting a paycheck, you're able to buy less and less and less with that paycheck. Cost of rent, up. The cost of a car, up. The cost of college, up. The cost of your groceries, up. The cost of gas, up. And when you look at the fact that inflation has skyrocketed and the average wage in America has not increased to keep up with the pace of inflation, now we start to have a problem. I'll tell you how we're going to fix this problem. Thing first, we're going to model after the top 10%. One of the things that's very much in your control is being able to start a business. Now, you can start a business through selling your own goods and services, or you can become a content creator and you can market other people's products and services, and you can get paid from the affiliates and the commissions. And this is actually a lot easier to do and a pathway that majority of y'all listening to me will actually have success in doing. Okay, all you have to do is drop the word money in the comments and I will DM you over the discount code and a list of trainings to help you get started, even if you're a beginner. The next thing that you're going to do is you're going to run out and you're going to get an insurance policy. More specifically, a IUL is going to be the best policy that you can get. The IULs are really, really great. Typically, they have better returns than the market, and an IUL is going to have a living benefit and a death benefit combined. You don't wait till you get wealthy to start investing. You invest to get wealthy. To follow Wall Street Trapper or Tay Sweat, you can learn what to purchase and what to buy in the stock market. And you may not have hundreds of thousands of dollars or millions of dollars to invest, but you will be amazed with being disciplined with just an extra $50 to $100 a month, how much money you can amass instead of spending that on a new outfit or going to the movies or having an outing. Money needs to be tied to assets, not to your wages and your check. Your money being tied to your wages and check is what's keeping you in the lower 80% instead of moving you up to the top 10%. Something else you're going to do that's going to help you have more money at your disposal, you're going to find a friend, a neighbor, a family member, somebody that you can do bulk shopping with. You're going to end up saving tons of money doing it this way, and you can split it with your neighbor, your family member, or your friend. Remember, every penny counts, and we need as many pennies, nickels, dimes, and dollars to be able to put towards assets as we can get our hands on. What to do is you're going to commit to spending at least 30 minutes a day to financial literacy so you can learn more about business. You can learn more about sales, about marketing. You can learn more about returns. You can learn more about reinvestment schedules, all the stuff that you think is boring, but baby, it's really exciting when you look in your bank account and you see comma after comma after comma after comma, okay? You're going to make sure you follow me, you like a few of my posts, you comment on a few of the posts so I can stay in your timeline. That way I can keep you up to date with everything happening in the news, everything happening with your business, and everything happening to help you get some more money.
I'm going to tell y'all something that I've learned, and I'm going to really need y'all to keep this in y'all memory bank. You know what will really make or break a relationship? Seriously, truly, money. And I'm not saying that in the sense that when it starts to flee, that's when the problems start to arise, because that is true. But what really will break people down is money trouble, lack of financial stability. Money allows you to progress. This is what a lot of people don't really understand until it hits them. And by the end, it's too late. Money troubles, lack of financial stability, lack of financial progress will break a relationship down very quickly, because at any stage of your life, when you get married, that's costly. Everybody has a very serious case of FOMO right now, and we can divulge that in another conversation. Even the men want the extravagant weddings. That's how you know when consumerism is starting to make a major shift, when it's starting to really attack everyone. Women are the major consumers. They make the money, we use the money to consume. When the men start wanting to consume and overconsume, that's okay, but we'll divulge that in another conversation. After the wedding, you're going to want to buy a home. Homes are easily 10 times more costly now than they were back then. Easily. The overarching costs, from the mortgage to the interest rates to the utility prices to the taxes, overarching 10 times more expensive than our parents' day, and way more expensive than our grandparents' day. And then the inevitable, children. At every point, a child is going to cost you. Unless you are in a position where you can stay at home. And even then, a child is costing you, because then you're down in income. If you can't find a work from home job and you have to stay at home, now you're down to one income. Most Americans cannot afford that. Then you get over that hump where you might have to pay for childcare or lack an income until they get into school. You have to hope that school is offered for free or for a reasonable price. Then you fast forward years and years. Sports, not cheap. Extracurriculars, not cheap. Field trips, not cheap. Other kind of school programs, not free. Then we get to the driving portion. We get to homecoming, prom, driving, dances, all this. It ain't even free to graduate. Now, I'm not saying this to say that you can't get off in an inexpensive way, but everything costs money nonetheless. And what happens is people cannot grow. They cannot grow, they cannot progress, they cannot increase their earnings as all of these financial things come up. And the more you have to deny yourself all of these new milestones. You can't buy your baby first car because you're not well off enough. You can't buy a home because you're not making good enough money. You can't care for your child, so you have to be down in income. Those become strains on the relationship.
I think we're headed towards a financial crisis and another devastating transfer of wealth from everyday people to the ultra wealthy. And I don't know why more independent journalists aren't connecting these three dots. First of all, people keep touting that the unemployment rate is low, and that is like a signal of a healthy economy. But the way that we measure unemployment and the factors that have happened in the last few months make me think that it's significantly understated. First of all, you have to meet all three of these criteria to be included in that calculation. You have to have sought out work in the last 4 weeks, meaning if you are an engineer who got laid off of Google and you're like hanging out for the summer, you don't count. Similarly, if you were a part of the big tech layoffs and you're like waiting tables in the meantime until you can find a job, you're not calculated, because rule number 2 is you have to be completely unemployed, right? And then rule number 3 is you have to be available for work, meaning if your kids are off for the summer and you are staying with them until you find another job, you don't count. So given the mass amount of tech layoffs, I don't think that it accurately represents the people who are unemployed or underemployed. Second of all, US consumer credit utilization is at an all-time high. Americans are putting more and more of their expenses on credit cards than ever before. And of course, we know that we have super predatory interest rates, which means it's really hard to dig yourself out of that hole. And number 3 is that student loans are going to go back into repayment soon. The worst thing is that billionaires love this. If all of us are just scrambling for any job we can get, and keep in mind, in the next 5 years, half of all call center, food service, truck driving, and retail jobs are going to be automated. So it weakens our power and our negotiating ability because they can just replace us for someone who is happy to take a lesser wage. Also, it means that the stock market might crumble if there is a lack of confidence in the US economy. And they love that because they can wait it out and they'll just buy up a bunch of stocks at super low prices. And third of all, if people lose their homes, billionaires and huge investment organizations will just buy them up and hold on to them. It's a disaster.
People love to say that the 2008 housing crash hit everyone equally, but that's simply not true. And black home ownership proves it. Before the housing crash, black home ownership was already fragile. In 2008, it peaked around 48%, and then the market collapsed. According to the Pew Research Center, black families were far more exposed because they were more likely to buy homes at the height of the bubble, right before prices crashed. From '05 to '09, black households lost 53% of their median wealth, while white households lost about 16. That's not market fluctuation, that's devastation. Before the crash, black borrowers were systematically steered into subprime and high risk loans, even when they qualified for safer mortgages. The Urban Institute has documented that race, not just income or credit score, predicted who got dangerous loans. When the market crashed, those loans exploded first. Now, after the crash, the federal government moved fast to save banks. Programs like TARP stabilized financial institutions, but homeowners, especially black homeowners, got delayed relief, limited access, and complex requirements. And by the time help actually arrived, many families had already lost their homes. So let's fast forward to today. The overall numbers, home ownership rate is about 65%, but black home ownership is around 44, 45, which is lower than it was before 2008. This isn't abstract to me. I'm in my 20s thinking about what stability is supposed to look like, and home ownership feels further away, not closer. Houses are more expensive, wages haven't kept up, and we're being asked to believe in a system that keeps failing us. And even now, black mortgage applicants are more than twice as likely to be denied as white applicants. even when controlling for income and credit. So when people ask why Black homeownership never recovered after 2008, the answer isn't personal responsibility, it's policy choices.
One thing God is gonna do is put the girl up on game. I just had a whole epiphany about the people, the people that are in charge of our country. Y'all, they are funny as fuck. They are funny as fuck. And what I love about it is they do a lot of odd things, illegal things. But it's just it's kind of clever. Like, I ain't gonna lie, it's clever as fuck though. It's like it really is kind of clever when you think about a lot of the things that they do to kind of either balance the books, recalculate it's actually really clever. Like, I know a lot of people look at the downside about it, stuff like that. But if you finally believe that God provides and God will lead you to where you need to be provided from, then we wouldn't be having this conversation. But let me get back to the original topic. The original topic I'm saying is the people that rule our country are fucking hilarious and clever as shit. They are so clever. And I literally know that money is just numbers on a screen. And next year, that is exactly how you need to look at it. And then you need to assign every dollar to something. The reason why I say this is because the people that rule our country have already done it. So I'm telling you to learn how to do it. If you could do it with 100, you could do it with 1,000. You could do it with 1,000, you could do it with 10 racks. If you can do it with a penny, you could do it with a quarter. Just listen.
Do you know you could lose money without even spending a dime? Welcome to America's economy. You don't even have to swipe your card, tap your phone, or pull out cash anymore. You're still broke. That's the reality right now. You can sit in your house and not spend a penny, and you're still losing money. That's what out of control inflation does. And let's be clear, this ain't just bad luck, it's bad policy. If the policies were better, 9 times out of 10, we wouldn't even be in this predicament. Let's roll it back to COVID, right? Remember those stimulus checks that everybody got excited about? Free money, they said. But guess what? Free money comes with fine print. So those waves of government checks that got infused into the market, that helped to cause that first batch of inflation. And then to add insult to injury, you had to claim that money on your taxes. How you gonna give me money, then tax me for it, and then jack up my grocery bill on top of that? That ain't help. That's a setup. And nobody wants to talk about that part. Folks argue about minimum wage, workers, and greed. All valid, but let's not forget the core. Bad policy decisions stack the deck against everyday people. And that's why you feel like your money is evaporating. Let me ask you this. If you feel like you're losing money, even when you don't spend any, what do you blame? Bad policy, corporate greed, or both? Drop it in the comments, because I want to see where y'all stand on this mess.